The Federal Reserve just met on June 17th, and basically they held rates steady. But buried inside that decision, every single Myrtle Beach home seller, actually every seller around the country, needs to hear this. 9 out of 18 of the Fed officials expect a rate hike by the end of the year. And if they're right, mortgage rates will follow and they'll orbit up to the 7%. Let me explain exactly what happened at the meeting, because the headline and the reality are two completely different things. Here's the headline. The Fed voted 12-0 votes to hold rates steady. That sounds like nothing changed. But here's what didn't make the headlines. After every Fed meeting, every single official submits what's called a dot plot on where they believe interest rates are going to be by the end of the year. And the June dot plot submitted by all these officials is the most hawkish response that we've seen in this rate cycle in a while. Here's the breakdown. 9 out of the 18 officials expect a rate hike by the end of the year. That's 50%. 8 submitted their dot plot that no change will happen to the interest rates by the end of the year. Only 1 expects a rate cut by the end of the year. Put that into perspective. Everyone's been waiting for rates to drop, to decrease. And 17 out of the 18 Fed officials submitted their June dot plot basically saying that rates will either stay the same or go up. In March, the Fed basically said they expect a rate cut by the end of the year. And now they did a full reversal in 3 months and now expect a rate hike is going to happen. And mortgage rates will follow. There's one more layer to this that is very significant. This was Kevin Warsh's first ever meeting as the Federal Reserve Chair. Warsh did something that Powell almost never did. He stripped the Fed's statement down to 130 words, removed all forward guidance, and removed all language towards the bias of rate cuts happening. In plain English, the brand new Federal Reserve Chair walked into his very first meeting and made a statement more hawkish than he could have. He's not signaling cuts, he's signaling caution. And when you have 17 of the 18 Fed officials say inflation risks are tilted to the upside, driven largely by the Iran war and energy costs, you can expect rate hikes by the end of 2026. Now, let me connect this to how this affects mortgage rates. Because every single seller, if you're thinking about selling, and especially in my market of Myrtle Beach homeowners, needs to listen to this. The Fed doesn't set mortgage rates, but when the Fed indicates a rate hike, the bond market reacts immediately. The 10-year Treasury goes up and mortgage rates follow the 10-year Treasury. Right now, the 30-year fixed mortgage rate is sitting around 6.6%. Markets are currently pricing in the 125 basis points hike by October 2026. If that hike happens, that doesn't mean mortgage rates are going to hike up 0.25%. But between the hike itself and how the bond market reacts to this hike, we could see mortgage rates orbit up to 6.9 to 7.1%. Here's what that means for a buyer looking in Myrtle Beach, I'll use my market, for a $375,000 house. At 6.6% mortgage rate right now, putting down 10% to buy a house, $375,000, their monthly mortgage payment will be $2,160. Let's think about if it goes up to 7. At 7%, same down payment, same house, same price. The only change is 7% rather than 6.6%. Their monthly payment goes up to $2,245. That's $85 more every single month, $1,020 more every single year. And in 5 years, that is more than $5,000 more out of the buyer's pocket. And $85, I know what you're thinking. That doesn't sound that bad, Mike. That's not catastrophic. And I agree, it's not that bad. But you gotta remember something. You're not the buyer. You're trying to convince the buyer to give them their money for your house. So I'm going to go over what the buyer is thinking about this extra $85 a month. Buyers right now are already stretched. And when you got your resale house and a brand new builder, new construction house that's offering rate buy downs to 4.99%, That $85 a month is the difference between you getting an offer and that buyer passing on your house. Now, if you're watching this around the country, every market's different, but the Myrtle Beach market, homeowners are thinking of selling or currently selling are very exposed now. And this topic matters more for all the sellers here in Myrtle Beach than any other market around the country, unless you are exactly like our market. Our buyer pool is heavily toward out-of-state relocators. They're coming from New Jersey, New York, Pennsylvania, and from Florida, oddly enough, Florida. And what they're doing is they are selling their house, which is a whole lot more than a Myrtle Beach house, coming down here, relocating, and more likely retiring down here with tons of equity. They basically made a life decision to move, but they're not immune to rate sensitivity. A buyer selling $565,000 house in New Jersey has done the financial math to move here to Myrtle Beach. They know exactly what their monthly payment is going to be at 6.6%. But if the rates, mortgage rates go up to 7%, they could go on the fence and wait because they can. And if they still move forward with a purchase here, that might mean they change their budget entirely. Here's the other exposure that is specific to the Myrtle Beach market. We already have over 6,100 active properties on the market that's not selling. Average days on market is 118 days. That's 4 months. 4 months. And if you're watching this around the country, you're probably thinking, oh my gosh, my house sold in 2 days. I got multiple offers. You have a different market than Myrtle Beach. If a rate hike happens and the buyer pool shrinks by just 10%, that inventory number will go up. And sellers who are already on the market 90 days will start seeing 130, 150 days. The sellers who get out and sell before October, the next Fed meeting, are selling into the buyer pool right now. The sellers who are waiting are betting against the Fed. And right now, the Fed is not on your side. That's like you walking into the casino betting against the house. And the house telling you, I have a 17 out of 18 chance I will win. So here's my honest advice. If you're thinking about listing or selling, the window of the 6.6% mortgage rate environment is closing pretty quick. October is the next Fed meeting, which a rate hike will probably happen. That means you have about 6 to 8 weeks to get your property listed, marketed, find a buyer, negotiate an offer, get it under contract, get you to the closing table. If you're already listed and you're trying to sell, now is not the time to stand firm on your price. The buyers that are writing offers right now are writing offers knowing that the mortgage rates are going to go up. They're taking advantage of 6.6 while they can. Give them a reason to act. Offer rate buy downs. Offer to cover closing costs. And most importantly, correct pricing from day one, from the jump. The window that started at the first of the year with these rate cuts, that's gone. That is gone. We're in a completely new environment right now. So the good news is we didn't go up on June 17th, but the Fed did hold rates steady. But what they said about where the rates are going to go in 2026 is the key to this information, because it's looking like it's going to go up. The math on your buyer's monthly payment is already tight. And we have over 6,100 properties on the market as of today, and it's going to keep on increasing. If you live here in the Myrtle Beach market and you want to know the value of your house, please reach out to me. I'd love to help you out. And if this gave you a clearer picture on where the interest rates are going to go and how it affects mortgage rates, hit the subscribe button and the like. Drop me a comment. Let me know how I can help you out. Folks, have a wonderful day. I'll see you guys in the next video.